The last couple of months have been challenging for equity investors, and not just in India but across the globe. The broadline number like Nifty and Sensex may just show a 5-7% correction. We all know that the broader market correction across sectors and stock has been significant. Of course, the market was any which ways overvalued and the correction was due, but no one thought the markets will correct significantly in such short span of time. We tend to attribute the correction to Russia and Ukraine situation, but to be honest, there are three other reasons: interest rate hike, crude oil price increase and inflation are possibly those other three reasons because of which the markets have corrected to where they are. Let us try and understand them with some logical reasoning and data in this video. There is no doubt in our mind that the Russia-Ukraine standoff is a serious concern and one should keep a very close eye on the developments. But what we have seen with the data that is available in the public markets is that in the past, geopolitical risks have led to equity sell-offs only to shoot up again after 4 to 5 months. We saw this during Kuwait's invasion of Iran, where equity markets went down by 17% and the crude oil went up by about 200%, only to see that after a few months the equity markets were back at the top. So one needs to keep a close eye on the developments, but what we believe is that the markets have already discounted the fact that this standoff will continue for some time, and if there is any diffusion of tension, it could lead to a significant rally over the next few months. All we need to do is that keep a close eye on the fundamental and the economic scenario of both India and countries across the globe. Let's take the example of India and China's skirmishes in the recent past. Every time, though the market reacted negatively, you see that as there is an EPS growth trajectory, the markets are also going up. We saw that during India-Pakistan Kargil war, the markets did come off, but after a few months, the markets were almost cruising on the top. Keep an eye on Russia and Ukraine, but don't make that as the only decision point for your positions in the market. The second biggest factor is crude oil. Of course, crude oil being at $100 is definite bad news for our economy because we import a lot of crude oil. I really hope that one day we become self-reliant on crude oil or its alternatives. But I know that's going to take some time. What we read is that the crude oil prices are expected to come down to $70 by the end of June or July 2022. The reasons being the diffusion in tension between Russia and Ukraine, higher oil prices leading to increased production by OPEC plus nations, lifting of some kind of a sanctions on Iran can lead to decent amount of inflows into the market. The increased production of shale gas oil in the US and Canada, plus the reduced demand during summer, can all lead to crude oil prices coming down. So for all you know, we are near the peak of crude oil price hike, and in the coming days we may end up seeing lower oil prices. This is very good news for India, isn't it? Who's not worried about interest rate hike? I'm sure everyone across the globe has been talking about Fed's increase in interest rate almost on a daily basis. What is interesting to note in India is that the 10-year G-Sec rates, even though the oil prices have gone up, has come down from 6.94% to 6.75%. This is good news because I think most of the investors and the traders in the debt market are expecting that there may not be significant price or interest rate hike in the coming months or so. This is positive news for India because we are generally a borrowing economy, and this hopefully can keep the industry's demand very strong and borrowing very high, which is very good for the banks. One other thing to note, if you actually see, is that the US dollar versus INR price has been rock steady at about $75. I think one of the key reasons for that is good inflation management by RBI and also the forex reserve of over $630 billion. We are all worried about the impact of inflation on the EPS growth of many stocks in India. Of course, it's a worrying factor to see crude at $100. The good thing is that in the last quarter, the BSE 100 companies have shown decent revenue growth of about 30%. And the other thing is that in spite of crude showing signs of going up, our PAT growth has been about 25%, which is good. This should lead to higher EPS. One thing which we've all forgotten is that the third wave, the Omicron virus, is almost on its way out. This should lead to good consumer growth and consumer demand. This should lead to a business environment which is conducive for growth. This can lead to good returns for investors who are very smart in allocating their investments into the sectors that are undervalued today. These type of corrections have led to the market being attractive enough today to invest. Of course, the returns that you saw in the last couple of years are not going to happen again till the time there is a significant correction. What we believe is that if you are an investor for over 2-3 year period, you should see decent return going forward because of EPS revival. You also need to remember that the UP election results will be out in this month of March. This should be the turning point for all those investors worried about the globe, because India will get affected more by Indian events than by the global events. Let's really hope to see positive environment very soon. Good luck, happy investing.